Welcome to the program. My name is Marty Schenkman, and I'm joined on what I hope is a really interesting and very practical topic by Lauren Landolfi, Len Nitty, and Christine Pronek of Wilkin Gutton Plan, which if you don't know Wilkin Gutton Plan, they're a very large New Jersey firm. Are you guys outside of New Jersey or just Jersey?
So we are New Jersey based. Our main office is in New Jersey, but we serve clients all over the country and world in some cases.
Okay, so there you go. And I didn't mean to shortchange it. We all know that OBBBA was the One Big Beautiful Bill Act was enacted not so long ago, and it's affected almost seemingly every provision of the tax law. But what we're going to focus on, and there have been some other programs on it, but we're going to dig deeper than what I've seen done and cover it from a number of different perspectives, is the use of non-grantor trusts and how it ties into some of the tax benefits like the state and local or SALT deduction, 199A, which is the QBI or qualified business income deduction, which of course we as lawyers and accountants don't deserve, and 1202 stock. Now, I've done programs on specifically charitable planning and non-grantor trusts, so we're going to cover a lot of the landscape that hasn't been covered before. And to do it, I have three different knowledgeable CPAs who are going to each talk about an area with some specificity and hopefully explain it for those that are lacking some background. For lawyers that are participating, if you don't have the knowledge of these different provisions, now's a great time to start boning up on it. Certainly you can partner and should partner with a CPA that has more income tax knowledge if that's not your area of expertise, if you're just an estate planner. But the kinds of trusts and related planning we're going to be doing, gift planning and who should own what, may all relate back to this kind of planning. So it really can have a dramatic impact on estate planning. So hopefully this will be practical and useful. I think I've covered the agenda. Are we good to go on?
Good.
Okay, so let's rock and roll with 199A, the qualified business income deduction. And hopefully you'll explain it so lawyers like me can understand it.
Yeah, thank you, Marty. So 199A was created by the Tax Cuts and Jobs Act. And, you know, when we started hearing about this, they made it sound like a very simple thing. You know, we had the C Corp tax rate simply dropped all the way down to 21%. You know, that was a very simple change. And the answer for past owners of pass-through entities and sole proprietors was this concept of 199A. And you know, when you heard the politicians talking about this and reading about some of this in the paper, what it effectively does is gives everybody a 20% deduction, free deduction effectively against their business income. And it was designed to take everyone's highest tax bracket on business income from 37% down to 29.6%. What they didn't do a good job of articulating as they were promoting or talking about this initially was how complex of this they actually made this deduction. And there's a lot of different limitations put on it. Marty, you noted at the front that, you know, us as accountants and attorneys, we're not good enough to get this deduction. And, you know, same for doctors and some other types of professional services. And then on top of that, and we'll talk about some of these in a little more detail, on top of that, you also had to have certain tax attributes once you started to make too much money to be able to fully benefit from this. So this is something that's most interesting to individuals, trusts, and estates. Those are the three that can qualify for this. As I said, it's an up to 20% deduction of qualifying income, subject to the limitations we're going to talk about. And this was set to expire after 2025. So this was one of those Tax Cuts and Jobs Act's provisions that was scheduled to sunset. You know, so hurdle number one to be able to get this deduction is your activity has to rise to the level of a trade or business. There's no bright line test in the tax code or regulations. So it's, you're really looking at, are you in this for a profit? Are your activities regular and continuous in trying to achieve that profit? So it's a lot of different types of traditional trades or businesses would otherwise qualify for this. The one that the IRS has kind of targeted was triple net lease properties. There wasn't a thought that there's enough continuity there or regularness of operations for a triple net lease to qualify, unless they were in the trade or business of just doing triple net leases, where maybe they have 100 or so, was the number that a IRS attorney had given me that they thought was safe. So one must rise to the level of trade or business, and then it's not available for specified service trades or businesses once you exceed certain income thresholds. And as we said, specified service trades or businesses, there's a number of them: attorneys, accountants, healthcare professionals, certain types of brokers, investment advisors, those that are trading on their own name and image, athletes, celebrities that are going out and getting endorsements, those types of things. You don't qualify once you exceed certain income thresholds. And normally we have phase outs of deductions. Here they call it a phase in of the limitation. I guess a little friendlier wording, but get you to the same place. And when this came into effect, the threshold or the phase in started at 150 to 200 for individuals, trusts, and estates, and then a married filing joint couple had exactly double those thresholds. For 2025, we're at 394,000 for a married couple, and the phase out runs to about 495, and then for single individuals, trust and estate, it's exactly half that number. So about 200 to 250 is the range where this starts to phase in. If your income, taxable income or adjusted gross income is below that number, then you don't have to worry about any of these phase outs or these limitations. So
just a quick comment. One of the concepts, and I think Christine's going to talk about it later, is shifting income from your personal return to, say, a trust non-grantor or complex trust return to lower your income and meet the thresholds that Len was just talking about. But another concept, and I don't think we're getting into it, Len, but just so people are aware, just because you're a physician, for example, doesn't mean you can't do some of this planning. So for example, if your practice owns your office, you may be able to spin that office out, gift that office building to a trust, and pay an appropriate fair rent and shift some of the income off of the medical practice to a format or structure that may qualify. Does that make sense? I don't want to get too detailed in that, but just so people know, they got to, there are some planning options.
Yeah, there's some opportunity, but you have to be careful of some related party rules. When they were writing the regulations, they had contemplated that. And, certainly if the doctor owned the medical building and the practice in separate entities, the fact that the building is being rented to the medical practice also makes that rental activity a specified service trade or business. Depending upon who the beneficiaries are of the trust, you may get into a similar scenario where it could be the rental income could be tainted based on it coming from one of these specified service trades or businesses.
Just keep in mind that there may be some opportunities, but that's where, if you're not familiar with it as an estate planner, you got to talk to an accountant who is.
So once we get over the initial two hurdles of rising to the level of trade or business and the SSTB limitation, there's a secondary limitation that we have to look towards. And once you get past the phase in of the limitations and the income thresholds, you have to have either paid W-2 wages during the year to take the 20% deduction, or some level of W-2 wages plus qualifying basis in your fixed assets effectively. So you would go through and you would calculate what's your maximum deduction, this 20%. And then if you're using the W-2 wages test, you would look at what are 50% of your W-2 wages paid during the year. And that is the cap or your maximum 199A benefit. So it'll be the lesser of the 50% of W-2 wages or the calculated 20%. So as I said at the start, we start getting pretty complicated, and I think you may want to interject something, Marty.
When you say W-2 wages, is that just for the particular owner, professional, or is that total for the entity?
Total for the entity. And there is a potential planning opportunity there if it's structured as an S corporation, where one thing we'll do at year end is take a look at the 199A benefit versus the wages paid during the year. And if we could pay additional officer comp to the owners, it makes sense if it gives us additional 199A benefits. So it's something we do look at. That is a planning opportunity that we often consider at year end.
And aren't you then offsetting that against additional, let's say, FICA or something on those wages?
Yep, exactly. It's about a 9% income tax savings for, assuming they're over the Social Security limit already, for a 3.8% Medicare hit when you factor in the 0.9% on the the affordable care surcharge that they got in there now too. But yeah, it's a lot of moving parts and a lot of complexity to this. So it's not quite the simple 20% deduction that they were just giving you. So what happened under the One Big Beautiful Bill Act? We now have a permanent extension of the deduction. And I always like to caveat permanent extension, and that all it really means in tax law is it doesn't expire any longer. It's always going to be subject to change in the future. If Congress passes a new law to make any adjustments and the president signs it at some point in the future, it's only permanent until they decide to change it. And they also created a nominal $400 minimum deduction that you're entitled to, assuming you have at least $1,000 of qualifying income, regardless of whether or not you're over those thresholds or not, those income thresholds.
Why would they even bother with such a minute?
It seems silly, right?
I'd be afraid my accountant would charge me more for putting that on the return than the $400 benefit.
Yeah, it seems silly.
Let me just point out something, and you're going to hear this throughout the program and throughout almost every OBBBA program you listen to. There are so many little nuanced special rules that I would say it's probably impossible, even for tax experts that live in this stuff, to possibly keep all of this in mind. It's really incredibly detailed and nuanced.
Yep, I agree. So, Christina, I'm going to turn it over to you to talk about the tax planning for 199A with non-grantor trusts.
Sure. Thanks, Len. Just before we get into the planning opportunities with non-grantor trust and 199A, I just wanted to give a quick overview of what a non-grantor trust is. So it's a trust that's treated as a separate taxpayer for income tax purposes. It's an irrevocable trust. The tax itself, or the trust itself, will pay tax on its undistributed income. And to the extent that that income gets distributed out to its beneficiaries, there's a deduction at the trust level. So now there's taxable income of the trust, a distribution deduction, and then the final taxable income of the trust, if any's left after distributions. The beneficiaries have now picked up, and it's referred to as DNI, distributable net income. They'll get a Schedule K-1 coming out of that trust tax return, shows them their components that they need to pick up on their individual income tax return. And now that piece of DNI that the trust got a deduction for will be picked up and taxed over on the individual's income tax return. That's the quick overview of how a non-grantor trust works. There are two general types. If you hear people referring to it as a simple trust or a complex trust, it does not have to do with difficulty level. The simple trust has a mandate within the trust terms that income has to be distributed at least annually to its beneficiaries. A complex trust has the trustee discretion to make distributions of income. In either case, corpus can be distributed, but the income is mandatory to be distributed in a simple trust. and it's discretionary to be distributed out of a complex trust at the discretion of the trustee. So now getting into how these are useful, the non-grantor trust with 199A planning. As Len had mentioned, we have these limitations and thresholds that are in place that could potentially phase out the 199A deduction for someone. So as the grantor, if you make a contribution of these assets that generate this income over to a non-grantor trust, now you've just lowered your own taxable income because the income generated on those assets will be reported over in the non-grantor trust. Plus now you've lowered it to shift it amongst different thresholds. So a non-grantor trust, being its own standalone taxpayer, has its own thresholds for 199A. You move some of the assets with that income into that trust. We've spread it around a little and perhaps now met or gotten under some thresholds for the grantor as well as for the trust. And just to go back for a moment at what Linda mentioned with the thresholds, the phase out range for the deduction in 2025 in the non-grantor trust is 197.3 to 247.3. That's the particular range. That's where we're at for this year. And determining whether or not the trust has taxable income that exceeds the threshold, we're going to be taking into account the distribution deduction that I just mentioned previously. So if this trust now has X amount of income, but it's made distributions of some of its D&I to its beneficiaries, we're going to be looking at taxable income minus those distributions, and the remaining taxable income would be our focal point for the trust thresholds, plus whatever income stayed behind, because the income distributed out of the trust to the beneficiaries now moves over to their 1040. They've got the detail on that Schedule K1 that comes out of the trust tax return to show them the components of the QBI, and now they're looking at their own thresholds on their individual returns for the QBI thresholds and what kind of deduction they can get. That's part of the whole spread. It could either go into a trust and stay put in the trust, or if the trust makes distributions, now it's going on down to beneficiaries to be spread amongst their individual returns.
Just a quick point, and this goes back to something Len mentioned and something that you're mentioning in a different context. And since I'm not practicing as a CPA, I can plug CPAs. It's really important that clients sit down with their CPAs before the end of the year. If you want to determine how much more, as Len was describing, income, W-2 type salary income you want to pay out, like where the sweet spot is for that versus the 199A versus the FICA tax, et cetera. If you want to determine how the trust qualifies, you can make a distribution and enable the trust to then qualify. Christine, can these distributions be made under the 65-day rule in the next tax year and still work for the 199A for the prior tax year?
Yes, as long as the non-grantor trust that we're dealing with is a complex trust, meaning it has discretionary distributions that can be made by the trustee. Estates and complex trusts are able to avail themselves of that 65-day window, meaning that first 65 days after the end of the tax year of the trust, you have the ability to make distributions. So it's some nice hindsight planning, because you can take a look at what happened in that, say, the 2025 year, and in the first 65 days of 26, decide if distributions would bring us to a more advantageous tax situation. So yes, for estates and complex trusts, we can use that 65-day planning opportunity after the end of the year. Another thing I didn't mention on this yet, we'll get into it a little further later, is the SALT deduction. When you're using the non-grantor trust to obtain additional thresholds and benefits from QBI, you'll also be getting some additional bites at that recently increased SALT deduction. It was 10,000 before, now it's 40. I'm going to discuss that further at the end of the presentation, but that's another benefit to spreading this amongst multiple trusts. As far as how the trust is looked at, the RPE is relevant pass-through entity, and that goes back to what I was saying, is if the trust distributes some of the QBI out to its beneficiaries, those attributes are passing through to those beneficiaries for them to report on their individual income tax returns. And to the extent that the trust doesn't distribute and retains it, then we look at the trust and its taxable income and its thresholds to determine how much deduction the trust can get. And then I just got into some detail of what Leonard already talked about, the W-2 wages and the UBIA. It all works the same within the trust. We still have the same limitations, the same analysis needs to be done, and the same computations made to see how much of a deduction can the trust get. Now, state income tax planning. In addition to using a non-grantor trust or multiple non-grantor trusts to do some planning for the 199A, you can also look to putting or establishing these trusts in a state that does not have state income tax, basically a tax-friendly state. Examples, Delaware, Nevada, Tennessee. If the particular non-grantor trust that you're using is established in one of those states, now you get the benefit of avoiding some state income tax as well. So as an example, you set up a trust in, well, first let me just step back one moment. I want to talk about completed gift versus incomplete gift transfers, because there's two different types of trusts that can be used in these states to get the to avoid the state income tax. If you make a completed gift transfer, meaning that the terms of the trust are such that when that asset is transferred over to it from the grantor, you've now made a completed gift for gift tax purposes. Now you've moved an asset out of the grantor's estate. The appreciation with that asset is forever outside of their estate and growing in the trust. That grantor will file a gift tax return, and that grantor will have some impact on their overall lifetime exemption, which was recently now just bumped to 15 million starting next year under the OBBBA. So now you've got the estate tax planning component of it's a completed gift, it's out of the hands of the grantor, and it's in the trust, appreciating outside of their hands, and also taking advantage of this extra 199A threshold benefits. If it's set up in a state such as Delaware, you also won't be avoiding some state income tax. If you're a New Jersey resident, you know that whatever you report on your federal tax return, now it's going to flow down and be taxed in New Jersey. New Jersey does not even allow the 199A benefit. So you wouldn't even be getting the benefit of having that income on your individual return and then being taxed in New Jersey without getting benefit of the deduction. If you've transferred some of that over to a non-grantor trust, and let's say you've established that trust in Delaware, now you're getting the benefit of the fact that Delaware doesn't have a state income tax, and you remove that piece outside of New Jersey, provided that what we're looking at, what's generating the QBI, is not state-sourced income. Because even when you have a trust set up in a non-tax state, for example, Delaware, if what you have flowing through it is income that's sourced back to your resident state or to the state that does have income tax, such as New Jersey in my example, that piece will still be taxed by New Jersey. But you've got that possibility of either avoiding state tax completely if you don't have sourced income, or at least getting a break on some of the income that isn't sourced. The other,
Christine, doesn't that become very difficult in the sense that if a business is selling products online, how can you really know if you had somebody in a particular state? May you not get sort of snagged that you had some sales in that state? Could that be an issue?
Was this meaning if it's pass-through income coming into the trust?
Yeah, from the entity.
From the entity itself, if it's being a pass-through entity, you would have hopefully the state K1s telling you where your exposure is. So let's say if it's a partnership K1 and they give you the various states that they've got connection to and have had sales in, that's where we'd have to see, okay, so how much of this did you save because it's set up in Delaware, or was every bit of that income going to wind up flowing back to states because of sourced income? Is that what you meant?
Yeah, one of the things that maybe, and beyond what we're doing today, but just so you know, there's planning for each step of what Len spoke about, what Christine is now speaking about. So you may be able to give somebody a power to withdraw the income that's state-sourced income, so it doesn't stay in the trust and doesn't taint the trust and goes to that particular individual. So every step of the way, there's planning that needs to be thought about. This is getting more complicated than I thought when we started.
And just to go on to the next, that was completed gift, an incomplete gift transfer, and this is, talk about getting complicated, something called an ING. It's an incomplete gift non-grantor trust. So, yeah, sorry, thank you.
My fault.
That's okay. Being an incomplete gift, what I mentioned before on how that grantor now moved that asset and all of its appreciation outside of their estate, it'll be over in the trust. With an incomplete transfer, they still have it in their estate. When that grantor passes away, that asset is still valued and taxed to them. But what you do have is, for income tax purposes, you've moved it over to a non-grantor trust. So the non-grantor trust, as its own standalone taxpayer, would have the QBI benefits. You'd be looking at the QBI threshold within the trust. These INGs and typically get set up they get set up in a state that is income tax friendly. So if you hear NING, that's Nevada. If you hear DING, it's Delaware. They get cute. But that's what you can accomplish with these. Is say if the grantor is not looking to transfer the assets away for estate planning purposes, but wants to get the benefit on the income tax side, the benefit of additional thresholds for 199A, you can use these ING types of trusts. What you want to be careful about is the state that you reside in. Two specific examples are New York and California do not recognize the in trust as non-grantor trusts. New York specifically passed several years ago a bulletin stating that if it's an incomplete transfer, then they consider it to still be owned for income tax purposes by the grantor, and they don't recognize the non-grantor trust status, and they consider it to be on that grantor's individual income tax return. It's basically a disregarded entity. So if you reside in New York and you're trying to use an incomplete gift non-grantor trust, it won't work for you because of the New York barring that. And then Marty, I know you wanted to mention that the IRS has stopped issuing rulings related to Inc. Trust. I think they don't want to have the blueprint out there for people to follow and say, okay, this PLR said if I do this, this, and this, I'm good to go. They've stopped issuing them so that there's no roadmap out there.
But there's still a lot of rulings that were out there. What I understood, and this may be just hearsay, but a professor wrote an article attacking INGs and expressing in detail why they didn't work, and that's what prompted the IRS to stop issuing rulings. Christine, though, and let's leave aside Len's comment how permanent, you don't know what the word means in Washington because they can change anything anytime. But with a $15 million, I'll put it in air quotes so Len is happy, permanent exemption, might people that have been worried about using exemption in the past no longer perhaps care about it? So now they can be more comfortable doing a completed gift that would use exemption because for a married couple, it's now $30 million.
They can, someone in the past, as you said, who might not have wanted to use exemption to do the transfer and looked at the ING vehicle, yes, they might have a lot more comfort now saying, well, I've got this extra exemption I can use. I'll do the completed gift type of planning. And as far as the 30 million goes, that's of course meaning, you know, all the appropriate steps would be taken at some point for portability and all that if there's anything left on the table when somebody passes. But yeah, they might feel more comfortable now with extra exemption to work with. But hopefully they are still working with it. Nobody puts on the brakes just because the exemption went up. The planning is still important for a lot of reasons.
Let me just emphasize a really important planning point that's inherent in everything that Christine just said. Apart from the changes that OBBBA directly made, what Len and Christine have described, and we're going to hear more as we go on, it's really changed the analysis and the dynamic of how you plan. Whether a particular client should be doing a completed gift or an incomplete gift, a grantor or non-grantor trust, is different than it may have been before. And it requires some planning thought for new trust, which way you're going to go. And it also requires some evaluation of existing trust because it's not always easy. There could be adverse tax consequences. You have to be careful. But it may be advantageous to clients in some situations to change or modify an existing trust. So there's a lot of advice that a lot of clients are going to need, and it may often be different than what we had done pre-OBBBA.
A lot to take into account besides, and we'll talk about this in the next slide, it's not just income tax focused. You want to have other planning reasons and other goals. So when, say you take advantage of this planning, you want to use a non-grantor trust or multiple non-grantor trusts to, one of the benefits of doing it would be to get this additional bite at 199A and the deduction. But you want to keep in mind that the planning can't be focused on that it wasn't done specifically for that reason. And also under Code Section 643F, if the IRS looked at it and you had one grantor, or even the grantor and his spouse, because they'll be looked at as one grantor for these purposes, with the same primary or similar primary beneficiaries in the multiple trusts, and no legitimate non-tax reason for doing that, for setting these trusts up, the IRS could possibly collapse them into one. So if you wanted it spread across 4 trusts, these assets with the QBI, and have the benefit of additional QBI deductions, if it's not done properly, the IRS does have the ability, if they look at it, to say, no, this is not 4 separate trusts. You've got the same beneficiary going across the board with the same grantor. We don't see that you did this for any reason other than 199A planning. We're dropping it and calling it one trust. So now with the one trust, especially if you've used 3 or 4 initially, you're probably above your taxable income thresholds and not meeting the goal that you hope to. So it's important to have these legitimate non-tax planning reasons for doing it, such as asset protection, professional management of the assets for the beneficiaries, important to make sure your beneficiaries in the different trusts are different so that they can't look back and say same primary Benny in each of these with the same grantor. That is something that would be looked at or could be looked at.
Christine, I have 3 sons. If I set up a separate trust for each son, do you feel that passes muster under 643F so we could slice and dice and get more 199A or other deductions?
Yes, if each son is each trust is for the benefit of a different son, you're good. But if, say, you set them up for your 3 sons and then your wife set them up for the 3 sons, the IRS could come back and look at the one that each of you and your wife set up for son A and say, well, this is one trust. You know, that type of thing, because you and your wife would be looked at as one grantor. But in the example you gave, you have 3 different trusts with 3 different primary beneficiaries, and assuming we've got the legitimate non-tax reasons to establish them, you should be good.
So along with everything, there are great planning opportunities, like maybe you can do multiple trusts for multiple heirs, but you got to be careful because it can get unraveled if it's not done properly.
And the thought is, with all of this, the non-grantor trust becoming so popular with the provisions of the OBBBA. Oh, but we say OB3 and we'll get gut and plan, and I like it.
Oh, cute.
Sounds like Star Wars, but it's a quick and easy reference. But with the planning and the opportunities that are in there, I think this 643F might show up in a lot more court cases.
Yeah. Again, just to emphasize, one of the themes of everything you're hearing from Len and Christine is estate planning is now requiring input from an income tax expert, not just the estate planner. And if the estate planner doesn't have that knowledge, lots of smart accountants out there, just make sure you're working with one. But it's much, I would say it's more important now to infuse income tax planning when you're planning a trust than maybe it's ever been.
Right. For a long time, everybody said you don't want to ignore the income tax because look at the fact that, you know, for basis planning, when the grantor makes the gift, the trust is inheriting their basis. Now we've got all these other reasons for extra bites at the apple for 199A, for 1202, which we're about to talk about, for the SALT deduction. There, as you just said, more and more reasons to combine both your estate and your income tax planning together.
And by the way, I think it's incredibly important that wealth advisors and accountants talk to their clients about this, because a lot of people, I think the stat is something like 99.75% of people families won't be subject to an estate tax, just 0.25% will. So a lot of people know that these $15 million permanent exemptions are very high, and they may not be going back to their estate planners because they may not realize there's a benefit to. So when clients meet with accountants and wealth advisors, it's really in your purview to educate them, hey, there could be some really valuable planning here, and you may need to involve, or probably if it's going to be a non-grantor trust, involve your estate planner, but it's a different application. It's not just about the exemption.
Right. And there's always, and I know we've talked about this in other webinars, your non-tax reasons for planning with the asset protection and creditor and divorce protection and a lot of other reasons. Income tax being one, estate tax being another, but a whole bucket of other reasons to continue planning.
And asset protection applies to everybody. We live in the most litigious society. Turn on a radio and hear all the ads for people trying to seek clients for accident cases. So Lauren, you're gonna tell us about a topic that everybody wants to be conversant at. So at the Labor Day barbecue, they will be the life of the party.
Oh, it's not just me. You
No.
too. Wonderful. Yeah. So qualified small business stock, QSBS, section 1202, whatever, name fits best for you, was introduced in the law back in 1993. And as it was introduced back in 1993, is still relevant today. So we're going to start today just covering that law as it was enacted, what those requirements are to even meet the tests to be qualified small business stock. So the first main component is the stock has to be C Corp, specifically original issue C Corp shares, meaning those shares, you're the first person holding those, and you acquired those from the company, whether, you purchased them, they were for the performance of services, they were a gift, but you're the first person to hold those shares. Now, In addition, the corporation also has to be a small business. That's in the name of the provision. And so the definition of a small business has historically been defined as gross assets of less than or equal to 50 million at the time of issuance. So right after those shares are issued, we look at the balance sheet of that corporation. Are we going to trip that $50 million wire? Yes or no. If we say we're not going to trip that wire, we're good. We meet that small business test. Next, we have to be in an active trader business, and it has to be a trader business that's qualified. The 1202 qualifications are actually very, very similar to 199A qualifications. So many of those industries that Len was talking about earlier that don't qualify for the 199A deduction, those similarly do not qualify for 1202. So a qualifying trader business are going to be all of those businesses other than those in the performances of services. So accountants, attorneys, financial services, consultants, all out of the 1202 space. In addition, banking, farming, hotels also directly barred from being 1202 stuck in the statute. And the assets of the company need to be used in an active trader business. So when we're looking at what this company is doing, this C Corp, 80% of those assets have to be in an active trader business, can't just be, holdco. And one of the main hallmarks for 1202 historically has been that you have to hold those shares for 5 years, for more than 5 years, in order to receive a benefit. Okay, if you sell the shares prior to the 5-year mark, there is no benefit under these 1202 rules. Now, what benefits, you might be curious, are you going to get? Let's say we meet all of these tests. We're sitting there with issues of a C Corp that meet all of these various tests. If you hold these shares and then you go and sell them after that 5-year holding period test, then the benefits of 1202 say that you can exclude up to 100% of your gains. And the amount of gain that you'll be eligible for is dependent on when those shares were issued. I like to call them flavors of 1202. When 1202 was enacted, it was enacted with a 50% gain exclusion. So we calculate what your gain is, and you can exclude up to 50% not to exceed the per issuer limitation, which we'll talk about in a second. A couple years later, they enhanced that, and that deduction went from 50% to 75%, and shortly after that went from 75% to 100%. Whether you exclude 50% of your gain, 75% of your gain, or 100% of your gain depends on the date that your shares were issued. So it's statutory, it's fixed based on when those shares were issued. So once we have this taxable gain, now we have an exclusion amount. And the amount of income that we can exclude is the greater of two tests. And it's either $10 million, and that's a per issuer limitation, so per C Corp, or 10 times your basis. So it could be something north of $10 million if it was, a highly leveraged or, heavily venture-backed type of investment. But lots of really, really great potential options for tax savings for taxpayers. If we just put some numbers to it, I know there's most likely lots that are interested in that on this call. You think of a $10 million gain that's not going to be subject to tax at a 20% capital gains rate and a 3.8% Medicare surtax rate, ignoring any state implications, we're looking at, saving $2.38 million of real taxes, assuming that the shares qualify as qualified small business. So that's 1202 at, the 10,000 foot view as it was enacted. Again, I mentioned that's still relevant, and it will be relevant for any shares that were issued prior to the enactment of the One Big Beautiful Bill Act. Now, I mentioned initially that when 1202 was enacted, it was enacted in 1993. We have not seen much legislatively change over the past 30 years other than those exclusion percentages. And honestly, we weren't really expecting to see much to change. When OB3 came out of the House initially this spring, 1202 wasn't touched. It wasn't mentioned. And then lo and behold, the Senate version comes through, and the Senate decided that after 30 years, they want to look at some of those statutory hallmarks of Section 1202 and make some adjustments. Ultimately, those adjustments were passed, and now we look at Section 1202 with a few different lenses. We have our pre-OBBB, OB3, whatever we're calling it today, those pre-shares that will still have all of those same tests that we just talked about. Those are still relevant. But now for shares that are being issued post July 4th through today and into the future, we're going to have several new tests, which are really exciting for investors. And so the first is going to be our exclusion percentage. So remember initially we talked about those exclusion percentages before OB3 was enacted was 50%, 75%, or 100%, and it was based on the issue date of the shares. And you had to meet the 5-year holding period in order to have that gain exclusion. There are some provisions for 1045 rollovers or some other areas that maybe you don't pay tax on that gain, but if you didn't meet the 5-year holding test, you're pretty much not in a great space. For stock issued post 7/4/25, we actually have benefits of shorter holding periods, and those benefits offer different exclusion rates. So now for taxpayers that have shares issued after July 4th and they hold them for at least 3 years, we'll see at least a 50% gain exclusion for those shares. If they're held for 4 years, we'll get a 75% gain exclusion. And if they're held for 5 years, that 100% gain exclusion, as we've been accustomed to, will still remain. But this is really nice to give investors some opportunity to get an exit at, maybe a year or two earlier and still see some of those tax benefits on the other side. So really positive to see some exclusion percentage changes. So the next, again, I'm going to keep going back to this, has been unchanged since 93. So back in 1993, the definition of a small business was $50 million in aggregate gross assets after the issuance. And it's $50 million flat, that doesn't change. And what OB3 did was say for stock that's issued past 7/4/25, we're going to increase that small business test. And now a small business is defined as one whose gross assets don't exceed $75 million. So really, really significant jump in the definition of what's a small business. In addition, that 75 million is not fixed. That 75 million will now be adjusted for inflation. So the definition of a small business will continue to adapt and to grow as various economic forces and change in the world. So this is another one that's just going to make 1202 more available for a broader base of companies. Did you have a question?
Yeah, I was actually just trying to look up. I'm curious, what percentage of businesses have assets over 75 million? I'm not getting a good answer, but I can't imagine it's a very large number. That's a huge number.
It's a huge number, exactly. I think a lot of taxpayers are going to be surprised by this. I don't have any of those figures either, but definitely exciting stuff
It
there.
encompasses the vast majority of all closely held and small businesses.
Exactly, exactly. Marty, I think you might have flipped over
Two slides?
2 slides, yeah.
Sorry about that.
No worries, this is the big one, so I wouldn't have let you forget this one. So one of the items that's, again, been statutory is that $10 million exclusion or 10 times basis. So it's not small potatoes by any means, but for shares issued post 7/4/25, bigger potatoes now, because that exclusion amount is now gone from $10 million up to $15 million. So again, everything that's issued, we have to really look at when these shares are issued. So all those pre-OBBB shares will still have that $10 million cap. But for shares that are being issued now, we're going to have the option to exclude up to $15 million or 10 times basis. In addition, just like that asset test was indexed annually for inflation, this test or this exclusion amount will also start being indexed for inflation. Now, it doesn't mean that once you meet that $15 million cap in any year, if a future year frees up some exclusion, you'll be able to take the benefit of the inflation adjustment. Once you meet a cap in the year for that issuer, then you're done. All of the future shares of that QSBS will no longer be eligible for any exclusion because you've maxed out. But another $5 million is definitely not something that anyone would say no to, escaping income tax from, for sure. So then we can go over to the gain exclusion and the AMT impacts. And this isn't quite as exciting, more so just because of what we've seen in some other flavors of QSBS. So initially when QSBS was enacted in 1993, it was a 50% exclusion percentage, and there was an AMT adjustment. The AMT adjustment said for the amount of gain that you excluded for regular tax purposes, 7% of that had to be added back. 7% of the excluded income had to be added back to AMTI. That applies to the 50% flavor and the 75% flavor. It does not apply to the 100% flavor under the old rules, and OBBB made that permanent. So essentially, all of the shares issued post 7/4/25 will not have that AMT preference adjustment that we had seen in others.
Can I ask you two questions?
For sure.
And maybe, forgive me, I may have misunderstood, but does that mean if you have to post July 4th, 25, hold it for 5 years? If you hold for 5 years, then there's no AMT preference. Is that what that means? Did I get that
Correct.
right?
Yep, exactly. And it's not even all of the shares for post 7/4/25 won't have that AMT preference, even if you're in a 50% exclusion because you only held the shares for 3 years. What OBBB says is with regards to 1202 is that there won't be an AMT preference for 1202 excluded gains.
So I was wrong. You're scot-free. There's no AMT add back for any of these.
No, only for the shares that were issued pre-OBBB, exactly, right. And it fits the 50% or 75%. So most 1202 shares now are actually not going to have an AMT adjustment. It's only a small subset of very, very, those first issued QSBS shares that'll see that. AMT adjustment.
Let me ask any or all of you just a question, and you can just make a wild. What percentage of clients, taxpayers, actually pay an AMT anymore?
So not many, although, and listen, we've not really gone through and done the case studies detailed yet to see how the impacts are going to shake out. But while we did get expanded AMT exemptions under OB3, we also got a cut of the exemption. So we'll see if this, short story, we've not seen many taxpayers in AMT since the enactment of TCJA. Because of the changes in AMT under OBBB, it might change slightly on a go-forward basis, but I still don't think it's going to be as meaningful as it was 15 years ago.
Yeah, that's kind of what I thought.
That's my sense.
For mere mortals, TCJA is the Tax Cut and Jobs Act of 2017.
Yes. Sorry, my habit is to use acronyms.
we love that. We love that kind of technical talk. What about New Jersey?
So only because New Jersey is near and dear to my heart do I mention this one. Practicing in 1202 space in the Northeast, generally I've had to have lots of disappointing conversations with my founders and those in the venture space when they have this really cool exit that they've saved some level of federal tax and are surprised to see an inclusion for New Jersey income tax purposes. Historically, New Jersey has not offered any exclusion benefits or followed any type of 1202 principles, and that changed, not surprisingly, in line with when the federal government was making their changes. And so for tax year 2026, New Jersey actually now conforms to federal 1202, which is great. So, if you have any shares of closely held C Corp stock that are in process and you're a New Jersey resident, if there's anything you could do to delay that until January, it might have some meaningful New Jersey tax savings.
Not meaning to put you on the spot, but can you
Sure.
just comment about some of the other states? Just generically, do many states have 1202? Only a few?
Only a few. New York follows, California follows, but it's hit or miss. Many of the states that I also have clients that live some of these higher income tax states, they do follow, but oftentimes we're planning with clients residency planning as part of 1202 planning, and Christine gets involved in the trust side often in that space too.
Okay.
So just a couple planning considerations from a 1202 space before we get specific into the trust planning aspects of 1202. And this is just based on the fact that we have a few new tools with 1202 because there's been some changes. So first, if we're a taxpayer that's holding shares of QSBS, and we have a few different issuance dates, we have some shares that were issued before the enactment of OBBB and some that are issued after the enactment. Some planning, this isn't going to happen for like 5 years from now, but some planning about what shares to sell first is going to be important because there's an opportunity to sell the pre-7425 shares first and max out your $10 million per issuer exclusion before selling the post-74 shares and now getting an extra $5 million because we're in a $15 million exclusion. And PS, it's going to be something bigger 5 years from now when we actually see this. So careful planning, identification of shares that you're selling is going to be really, really important. In addition, there's some S Corps. So we initially talked about the qualification requirements. You have to be a C Corp and always functioning as a C Corp in order to be 1202 qualified small business stock. There are some more advanced corporate reorg techniques, F-reorg specifically, that can take existing S Corps and maybe make them possible 1202 QSBS beneficial type businesses. Lots of nuances in how that's effectuated, but certainly things that we are going to be planning for. And then as we've discussed, the state level planning is something that we're also always looking at. But lots of great stuff in 1202.
How do you advise people? Because it seems that in many cases, people just knee-jerk set up an LLC, but this benefit is potentially huge.
It is.
What do you suggest to people when they're evaluating the form of entity to use?
So for me, I spend a lot of time talking with founders. And so the first question I ask is, how does your story end? We have to have a little bit of a future planning focus. We have to dream big and think of what that exit looks like, and understand what our ultimate goals are. And once we understand that, then we can roll our sleeves up and figure out entity decision conversations. The reality is that oftentimes in this space, you have a founder that is very, very passionate in what they're doing, and they are, full steam ahead. And oftentimes come to me. Sometimes I feel like I'm a priest, like they're confessing all their sins, the errors that they may have made. But as soon as you get your house in order, have a conversation with a professional. There are opportunities to convert LLCs to C Corps by making check the box selections. That becomes the original issue C Corp date, so still gets us some nice 1202 benefits. Just because you started making some moves doesn't necessarily mean you're dead in the water. It's best to have a conversation sooner rather than later because adjustments to the entities classification might have tax implications, and we want to try to limit those as much as possible.
Good stuff.
Thanks.
Christine, I bet this is you. I see the word trust.
Sure, I'm back. So use of non-grantor trust for 1202 stock, and some of this is going to sound like some deja vu with what we talked about with the QBI planning. But with respect to QSBS stock, the exclusion that Lauren talked about, the gain exclusions of 10 million pre-OB3 and up to 15 million post-OB3 is a lot. Some clients are interested in spreading them across multiple non-grantor trusts because each trust, as its own standalone taxpayer, gets its own exclusion. So if shares of stock are gifted to, let's say, Marty, your example before was you'd set up 3 trusts, one for the benefit of each of your sons. Now you're going to have in each of those trusts the 10 million exclusion for stock that have been pre-July 4th, 25, or 15 million if this is done down the road and it was acquired post 7/4/25. Each trust gets its own gain exclusions. So we're spreading that out similar the way for 199A, you spread it across trusts. Lauren had mentioned before how you want to be the original owner of the stock when it's sold. Gifting, and she had mentioned gift in hers as well. Gifting is an exception to that rule. You can gift the QSBS stock to someone and that person is now still looked at as an original holder. They completely step into the shoes of the person who gave them the stock. So in this case, the trust receives the stock from the grantor. The trust now has the grantor's holding period. The trust now has the grantor's basis, and the trust is now looked at as the original holder. I mentioned the exclusions for trust and the dates you want to look at, the before and after, the 10 or 15 million. With respect to timing and documentation and business activity, all of those qualifications that need to be met for this to be considered 1202 stock that qualifies for gain exclusion, the trust would need to, needs to be prepared to support or document that as well. So upon transfers of stock from the grantor to the trust, we'd want to have that documentation in file and know that we're ready to prove this is qualifying stock at any point in time that may need to be proven. On the estate planning side, and this is where I get into my deja vu slides. If it's a completed gift to a trust, now you've just made a move from an estate planning standpoint because the grantor has taken the stock and moved that stock with its value over to a non-grantor trust. Any future growth will be growing in the trust outside of their estate. That's when you've made a completed gift. And in a moment, I'm going to talk about last minute transfers, just what you want to avoid there. If the transfer is an incomplete gift, like say if you want to use one of those ING trusts that we discussed earlier, the incomplete gift non-grantor trust. So now it's an incomplete transfer. It's not going to utilize any of the grantor's exemption. Don't have to file the gift tax return, but you have moved it over for income tax purposes to this separate standalone non-grantor trust. So again, we have those 2 different options of do you want it to be a completed gift for your estate planning purposes? Are we looking at an incomplete gift? And then still getting to the ultimate goal of moving the stock along to the non-grantor trust to get their own separate standalone gain exclusions. Similar to the 199A, we want to watch out for section 643F, the anti-abuse rules. If you set this up in trust where you've got the same beneficiary in each one coming from the same grantor, the IRS could look at it, attack it, and decide to collapse it. So now where you might thought maybe you had 4 trusts and you've got 4 separate gain exclusions, they collapse it, you've got the 1 gain exclusion. You weren't able to accomplish what you thought you could have because we ran afoul of the anti-abuse rules. And similar to what we discussed earlier, you want to have a legitimate non-tax planning purpose. Asset protection, professional management of the assets or the financial assets within the trust for the benefit of the beneficiaries, not just, oh, I want to do this to get extra 1202 gain exclusions, additional reasons for why it made sense to establish several non-grantor trusts.
Christine, just to emphasize the math, so if I have qualifying stock and I have trusts I set up for each of my 3 sons, I could put stock in each of those, and now we get 15 times 4, 60 million of exclusion.
Right, you've got your own for what you retained, and then this qualifying stock in each of the trusts, they have their proposed 7/4/25 acquisition of stock. They would each have their own 15 million as well.
Huge numbers. So when clients start complaining about their professional fees, just remind them, look at the potential benefits of this. It's huge.
Right, look what we did for you. And the last thing I wanted to mention was the last minute transfers. When I refer to that, it's basically if you have a sale of QSBS stock that's imminent, like basically on the table, and you think, well, hold on, I want to transfer some stock over to the non-grantor trust, I want to get some additional gain exclusion, you'll have a problem there because that kind of last minute movement, the IRS can look at it and they apply what's known as the assignment of income doctrine and say, no, this gain is yours. This gain was really established. There was a deal that was already on the table. this is attributable to you, and that last minute shift that you just did right before the sale is not going to successfully move that portion of the gain away from you. So planning is for two reasons. One, to avoid this assignment of income doctrine, and another, you want to plan early with the stock. Plan it with, you know, the lower value and get the most bang for your buck when you're moving it into the trust, because that appreciation, if you're going the completed gift route, that appreciation will be outside of your estate. So two reasons to keep, you know, planning sooner rather than later in mind. And state income tax planning, as they say, deja vu all over again, similar to the 199A. You can use, you can do incomplete gift transfers, which are those INGs, the incomplete non-grantor trusts, set them up in a state tax friendly state. So now you'd have your gain exclusion at the federal level, and you don't have the state income tax at all at the state level, and you've saved all of that. Say if you were a resident of a state that, using New Jersey for 25, I know they'll be friendly now in 26, but say New Jersey in 25, and you sold your QSBS stock, you had some federal exclusion, but you didn't have any New Jersey exclusion. If you had that stock in a trust that was in a tax-friendly state like Delaware or Nevada, and it had the same sale, you'd have the federal exclusion, and you would have had no state impact because it's in a trust that doesn't have a state income tax connection. And with this being C Corp stock and intangible, now we're not concerned with looking back at the state sourcing rules the way we were with the QBI deduction. Again, with the Inc. trust, keep an eye, just be careful if you live in New York or California, they won't respect them. And I think that was the overall gist of the state income tax planning for 1202, very similar to what we discussed earlier for 199A. Did you have anything about that, Marty, before I move into the SALT deduction?
We're going to change gears and talk about another big deduction, which is the SALT deduction.
Yes. So the state and local tax deduction, the SALT deduction, which the TCJA made, put a $10,000 cap on it for taxpayers, which I'm sure anybody in any state with state income tax has felt it, but state of New Jersey, if you used to be able to deduct your state income taxes and now you were hit with, and your nice high real estate taxes, and all of a sudden you could only take 10,000, it hurt. So there's a little bit of that has come back. The SALT deduction now has been raised to $40,000 starting with 2025, and it'll be a 1% increase to that $40,000 amount through 2029. And then in 2030, the way it's set right now, we're going back to the 10,000. So now using trust for this, each non-grantor trust as its own standalone taxpayer will have this potential $40,000 SALT deduction, phasing down to 10 to the extent that 30% of the trust's modified adjusted gross income is over 500,000. So when you split your shifting assets to the trusts, the income that's earned by those assets is also being moved over. The grantor themselves might have now just lowered them into a tax bracket where they can get the benefit of the 40, and the trust itself, depending on the income that's generated, may get the benefit of the 40. So you're getting extra bites at this as well, the potential $40,000 SALT deductions, not just for the grantor, but shift it over and get it in the benefit of the trusts also.
Christine, would you do this by, for example, taking a vacation home, maybe putting it into an LLC so it's easier to divide, and then giving slices to the various non-grantor trusts? And then each trust with whatever other income producing assets would pay the tax and get its own SALT deduction?
Each trust then having its piece of the LLC, I guess, flowing through real estate taxes and plus their own state level income taxes, whatever there. Each trust, if they're under this, the phase out range would get their 40,000. Yes.
And the phase out range is the same, 500, phases out from 5 to 6, even though trusts hit the maximum bracket at only 15 and change?
Right. Even though at 15,000 and change, you're looking at the 37% tax rate for a trust. This is the AGI limitation that applies to them at the 500,000.
So now we can take our non-grantor trusts and get 199A deductions, 1202 replications. That's not the right word, but supercharging, if you will, the 1202, and enhancing or replicating SALT deductions.
Right. It's you've got these, as you said before, with the new law, the OBBBA, we've got all these opportunities now to really utilize non-grantor trusts to do a lot more than just estate planning and a lot more than asset protection. It's the stacking for the 1202, spreading across the income to get under thresholds for 199A. and additional shots at the $40,000 instead of a $10,000 SALT deduction.
A lot of great opportunities. Since
Opportunities, yeah.
we're done with the slides, I'm going to ask you a couple more questions to anyone who wants to answer. Have you guys had these conversations with clients? I've started a little bit. I'm concerned that it's complicated and it's hard to get clients to, I mean, if I can throw out the 1202 numbers, the numbers are big, it gets them excited. Even the SALT deduction gets exciting, but it's very complicated. If you, any suggestions from Len or any of you about how you approach clients to try to help them understand this? Because each of the deductions, the SALT, the 199A, and the 1202 are complicated in themselves. And Lynn started off by saying that. But when you add the planning with the non-grantor trust, it's ever more so complicated. Any comments, thoughts? Because I think that's something every practitioner is going to be grappling with. How do I help people understand this stuff?
And I think the best way is you draw the picture with numbers, like really show them here, if this is all in your bucket and you don't transfer anything, here's what we're looking at as a potential tax hit. Now we could do this, you know, use one non-grantor trust, two non-grantor trusts, and now here's what you're looking at is your potential tax hit. Because even with on the estate tax planning side, when you really draw the picture, I know this is what I've had luck with, is the numbers. It's saying, okay, you can hold all your assets and here's what your estate tax bill would look like. You could shift them and here's how much you could save, because you want to really make them understand this is how much you could benefit. Because unfortunately, one of the first hurdles is they start thinking of the cost. Oh, now we've got the attorney, now we've got trust documents, now there's additional tax returns, and they're already adding up extra fees, but they don't have a good, clear picture of what's the savings, what's the benefit, that even after those fees, how much did you just, you know, save for yourself?
And it could be a lot.
Yes, especially like 1202. You spread that across and get extra bites at that, you know, $10 or $15 million gain exclusion. Never mind the non-grantor trust prep fee, you know, you just save tons and tons, but I think they just need to see the numbers.
Yeah, and I think though, but that's also going to be a further shift in the dynamic, because you're going to need estate planning attorneys to draft the non-grantor trusts. I truly hope clients don't go to, I won't mention names, those online web services to get a non-grantor trust. That's just, you know, it's one thing when they're doing a standard revocable trust for an intact family, but not a non-grantor trust with this kind of planning. But it sounds like the attorneys are going to really need to proactively partner with the accountants, because I, as an attorney, can't do an income projection, and you do them, you know, in your eye with your eyes closed, because you do them all the time.
Plus, it even can come down to the information we have access to if they're our individual income tax client and the business client, you know, versus what you might be seeing when it comes to planning. The attorney and the accountant together get the whole picture, financial advisor as well, and you've got a whole picture that you're working with.
Yeah, no, the collaboration is going to be more and more important. But it's fascinating, and I'm sorry that I've repeated this a bunch of times, but it's really significant that the focus of a lot of what we call estate planning is going to have a very important income tax overtone to it. And the estate planning is different with the $15 million, and I know Len said permanent may not mean really permanent, but with a $15 million exemption, do you want to complete a gift or an incomplete gift? Do you want grantor or non-grantor? The whole calculus has really changed.
It's more than just worrying about what used to be the basis planning. You know, okay, you made a gift, now they get your carryover basis. What if you've retained it and gotten a step up? It's all these additional income tax concerns for them to be looking at as well.
I think it's almost impossible to really figure out I think it probably is impossible to figure out optimal, and you can never figure out optimal, because by the time you figure it out, they'll probably have changed the rules again.
There's usually a few right answers, which is nice.
Yeah. Why don't each of you start with Len, then Lauren, then Christine, just make any concluding comments or thoughts that you want, and then we'll wrap up.
Yeah, I think, you know, as we touched upon, a lot of this is complicated, right? So you need to consult your advisors. I think the good news with this law compared to the Tax Cuts and Jobs Act is it was an extension and modification to a lot of what was already in place. So hopefully it will be easier to manage from a compliance standpoint, not only, you know, helping clients through this, but also working with the IRS to understand things maybe a little more quickly, and they'll get forms together. This way we can continue to be more focused on planning with our clients and helping them to take advantage of some of these small changes to existing code sections or extensions, where I think it'll hopefully be an easier thing, because we're not starting from square one with trying to help them to understand it and then help them to understand how to take advantage of things.
Absolutely. And, for me, I kind of reflect back to a year ago when there wasn't really clarity as to, what was going to happen politically. And so there was a lot of concern about these exemptions being cut in half. And so the reality is that we have, a nice enhanced $15 million, $30 million exemption. In theory, we'll have that for a few years under the permanent expectations. And so, for me, it's a continuation of all the discussions that we've been having with our clients, with the attorneys, with the income tax planners. But it's, double down on those conversations. Make sure you're rolling up your sleeves with the holistic planning team. There's more time to thoughtfully put together plans, move some of the levers around to see what makes the most sense for your situation before really trying to think about executing in the next couple of years.
And just being aware and keeping in mind what these, as we were talking about the trust, the planning opportunities that are out there, and not just from an estate tax planning standpoint, all the income tax opportunities that are there from the use of these non-grantor trusts and the benefits that could be obtained from either using multiple trusts, or it could be one trust with multiple beneficiaries, but the different ways that they could be making the most of the new tax law changes.
Let me make one final self-serving comment, not for me, but for you guys. Not every accountant is really expert in non-grantor trust Form 1041 filings. It's complicated, and the applications that Lauren, Len, and Christine talked about today are even more complicated than the complications that were the general state of affairs for non-grantor trusts. If you are a CPA and you're not really versed and comfortable and knowledgeable about handling the compliance, because as you see, it's not just the compliance, it's the planning and the monitoring as well. Bring in an outside expert. You don't have to jeopardize or lose your relationship with the client. Just bring in an expert to handle that one item in terms of the client's work so that you know it's being done right. It's complicated. And I've seen a lot of mistakes over the years with trust returns just done terribly wrong, and it has a very detrimental impact. And I think based on what you've just heard for the last hour or so, it could really be bad under the kind of planning opportunities that we have now. I want to thank Wilkin Gutton Plan for letting three people help me on one webinar, and I want to thank Len and Lauren and Christine for participating. I think it was a great program, and I thank you. I think it was understandable, and we covered 3 really important tax topics and the use of non-grantor trust for each. If you wanted to hear more about charitable planning and non-grantor trust, there's another program on my website you can access on just that, but this now covers different aspects of non-grantor trust planning. Thank you everyone for joining, and thank you 3 for a great program.
Thanks,
Take care,
Morgan.
everybody.
Thank you.